Welcome, everybody. This is Axel Merk. I'm the President and Chief Investment Officer of Merk Investments with our latest chart book. As always, these chart books are prepared by Nick Rees, and this is my interpretation of these chart books. The blue text on the bottom is Nick's interpretation. If you want to download these charts, please go to merkinvestments.com/research. You can study them in more detail. You'll also get a recording of Nick's analysis, which may differ, and indeed for the S&P, I believe it does differ in several significant ways. So please do listen to both our views to get a full picture of these. The first chart of these is a kind of a basic valuation indicator. Some academics don't like it because it is the way it is constructed. It's basically an autocorrelation. But what it does mean that if it is correct, then the returns over the next 10 years in the S&P 500 before investment of dividends should be close to zero. Differently said, valuations are fairly high based on this particular metric, and this particular indicator is based on how money is allocated on stocks versus bonds. And you can read the details here and look into that reference Z1 report on how this is constructed. And I like to use this one not so much as a real forecast, but as a sentiment indicator for investors, how they might want to think about their portfolios. And we always learn that, you're supposed to kind of have your risk tolerance and then invest accordingly. And of course, risk only matters on the way down. On the way up, you love it. And so many people are asking, well, when should you start taking chips off the table? When should you rebalance? And as you'll see in this chart book, many of the indicators that we have are reasonably positive, but it is very clear that volatility has increased, and it should increase as interest rates move higher. Discounting future cash flows more as interest rates go up is the appropriate way to look at this. And so if one is more concerned, that's right. But what do? Do you go out hiding, or do you just take chips down? And there are many frameworks one can use. This is one framework one could potentially apply as a valuation indicator, and this is just one example. Moves higher, well, might as well use that rather than something else if one kind of pares down the risk. Now, if you ask others, well, hey, should you only be invested on the way up and then not on the way down? Yeah, of course. But how do you determine when it's up and when it's down? Most investors, through actively managing their exposure, get it wrong. And if you just bought and hold, you would be better off. But those academic studies do you no good if you just have the stomach-wrenching feeling that you are taking on too much risk. And by the way, that is, in my view, the best risk indicator. If you have more risk than you can sleep with at night, then you're overexposed. And so you might as well rebalance before you get to that point. And so with that said, earnings backdrop is good. Now, a lot have been made that there's a slowdown. Well, there's a slowdown in the rate of growth, but not in the growth itself. Earnings are expected to continue growing. Historically, the shaded areas here are recessions. Historically, when the earnings momentum or the earnings have continued to move higher, even with a slowing earnings momentum, equity markets have been okay. The business cycle is doing very nicely. And so here, the leading economic indicators suggest the recession is not around the corner. And then the global growth background is far more mixed. These are purchasing manager indices around the world. The black line is the S&P 500. In this case here, the green line is the German PMI that's been coming down. And readings above 50 suggest a continued expansion. Some PMIs around the world have dipped negatively, but here these are the largest ones. They are in positive territory, but clearly we have with Germany the biggest party here in Europe. Some people are concerned about a global slowdown. Also, some people have said, eventually something in the U.S. is going to get things to slow down, but we are still firmly on the growth side on the PMI. Now, clearly, we've had some flare-ups in emerging markets. There had been some questions on China, and China here, by the way, is just above 50. That also means, by the way, that the emergency bells in China are going off and more fiscal stimulus might be underway, and that cutoff might not be exactly at 50. But so some stimulus might be coming from there. And incidentally, talking about Germany, Germany actually has a stimulative fiscal policy. Pensions in Germany will go up 3% next year. Holiday season is expected to be good. There were some short-term factors impacting the PMI in Germany. Notably, many cars couldn't be sold because there wasn't testing equipment available for emissions. As you may recall, around the globe there have been some emission scandals, and so there's been some throttling back of sales, and there's a backlog now. And so, and then at the same time, some of the slowdown is real because of trade, and maybe because of uncertainty around the world. There's less of an investment, but Germany is also capacity constrained. Unemployment is very, very low. Workers are difficult to come by, and so those sort of slowdowns might have different implications. That means inflationary pressures are continuing to rise, and rates may continue to rise. I'm talking about the Eurozone now, as even if economic activity slows down. Financial conditions, quite important. That's, in my view, the key indicator, or maybe not the specific index, but financial conditions in general is a key thing the Federal Reserve looks at. The Federal Reserve does not look at equity prices. I mean, they look at it, but it's not the key driver. The key driver is whether banks are lending. And in 2008, at the risk of repeating myself for those who have listened to me before, in 2008 it was kind of synonymous that the S&P plunged when credit conditions seized up, and so. But with that, we think that when the S&P goes down, the Fed will step in. I continue to believe that the Fed will tighten into what is eventually going to be a slowing economy, meaning this economic cycle is going to die a traditional death. And the reason is that inflationary pressures are gradually building up. The Fed has to continue to tighten, and as long as the credit markets don't really show signs of seizing, they'll continue to much higher. My view right now is the Fed will hike 4 times next year. Obviously subject to revision as we move along, but currently the market is pricing in about 2 rate hikes for next year. Market breadth, this is kind of a unique indicator that Nick has put together. As a bull market ages, fewer stocks are participating, and so this is after we've reached a new all-time high. When the next time we reach an all-time high, kind of what the breadth of the market is, and as reflected, how many stocks above the 200-day moving average, and we put in this line here at 65 just as a reference point. This is not a hard line, and clearly we are at the late stages of a bull market, but that doesn't mean the market will crash tomorrow, right? Just because the bull market has lasted for many years. Sentiment is kind of mixed. That's so there is, if you're contrarian and think that euphoria will mean the market will go down, people are not euphoric right now. Margin debt, there are different ways of looking at it. Overall, yes, people are borrowing money relative to the S&P. It is not extreme. Some people don't like it to make it relative to the S&P, but more broadly speaking, investors are not overexposed to debt. Delinquency rates are low, and even as rates go up and housing may slow down, housing is a much smaller portion of the economy. We do have some other chart books on that topic. Then I'm not going to explain this here again in detail. You can read this offline. What this chart, and together with the previous one, what these show is that the way to think about it is when in a panic environment, volatility is very high and everything kind of moves in tandem. And so as a contrarian, you said, when there's maximum panic, you may want to buy. So conversely, when volatility is low and you have a great dispersion, then everybody is happy. And so, and that's on the contrarian side means things can get worse. And so that's kind of what this chart is signaling, that there's a bit of complacency in the market here. And even with the recent uptick we've had, you see here the volatility has ticked up. We haven't seen anything yet. And so in many ways, the moves we've seen in the markets, and I think I agree here with Nick quite a bit, that the recent turmoil we've had in the market is mostly a sign that the market is getting used to this higher degree of volatility. my view is that high volatility will stay with us. That's part of the normalization. As interest rates go up, more volatility in the market. And of course, if you are an investor that has a certain risk profile, that will warrant you to pare down some risk. Might have already, and in many cases it has. In my view, hasn't done that sufficiently yet. And there's more and more to that. That, of course, will provide a headwind to risk assets, meaning the equity prices might be under pressure. But that doesn't mean equity prices can't reach new highs. The wall of worry is still there a little bit. I'm going to skip the VIX curve here and the technicals. I'm also going to skip here a little bit. Clearly, we've broken down here. This is here a reminder that calendar year returns are mostly positive, historically speaking, but they're rarely ever what people forecast. Nick has put together, based on the previous charts here, kind of a checklist. And everybody can have their own kind of weighting on these things, but it's very difficult to just say, hey, when you have 3 negatives and 2 positives, the market is going to plunge. Every investor needs to think about themselves, about kind of what sort of risk can they bear. And the sort of volatility we've had recently is a reminder of what it means to be there on the downside. Now, my own view is that you may want to, and again, here this is Nick's summary. You can read that as your own at your own pace. My own view is that an investor needs to think about, as this bull market is aging, how to get ready for what eventually will be a downturn. Now, how historically, if I go back here at some charts, where there's a recession built in, if we can get there here. Recessions don't happen all the time, but the S&P historically does poorly during recessions. And there are exceptions, like the 1987 crash, a very notable recession, obviously. And so are there other things? And many people don't want to take chips off the table because they might have to pay taxes. The argument against that is that, well, if you wait too long, you might not have to pay any taxes because your gains are gone, right? And so in my view, there are other things that you can do in your portfolio. For example, you can add real diversification, in my view at least, real diversification by doing things that work more on the interest rate cycle. And there are some things you can do on the fixed income side. But generally speaking, if you're an investor who says, all right, I'm only going to get out of the market when it's very clear that by historic standards, we should have a bear market, we are not there. We're clearly not there because the business cycle is in good shape. And the breadth of the market is not as weak as it can be. Now, that said, we had some bad news on some high-tech companies, and can that spread? Absolutely, it can spread. And so if you're somebody who rather take a cautious approach, by all means, a long time ago already, you might want to have considered to rebalance the portfolio. And importantly, what my view is, you want to stress test your portfolio. If look at days in the markets you've had recently, is what sort of things have worked in the portfolio, what hasn't worked, and then think about maybe add some diversification as this volatility will remain elevated. Anyway, I'll wrap it up here. merkinvestments.com/research. Make sure you're on a mailing list if you obtained this from somewhere else. Also, you can reach out to us if you want to learn how we can help you with portfolio management. We these days do offer some broader services that can help you navigate as this downturn comes, including things you can do with interest rates and the like. Anyway, that's it, and talk to you next time.